I'm joined now by Sean Binkley, a financial advisor and mortgage broker. Good morning, Sean.
Good morning.
We have been chatting about holiday shopping, and of course it's on many people's minds as we head into December. And oftentimes grandparents are in an interesting situation because they have a few ideas on what they want to get the kids, but you have some ideas that might help in the long term.
Yeah, they have a few ideas. They may not be the right ones. You know, for that grandparent that thinks that they might want to buy their grandchild the latest Backstreet Boys CD.
Yes, that'd be for Bill Welichka, I think. Yeah.
There you go, or the Atari gaming system,
yes,
right?
Yes,
but, you know, why not give the gift of education? The grandkids are hard to buy for, right, on any day, but if grandparents can contribute some of the money toward a child's education, that's really a gift that's going to last forever.
And we have an example to show you just to explain what you're talking about, how that amount that they give can have long-lasting effects. So this is an example, $25 a month from birth. So walk us through that.
Yeah, so often people will complain about the government and not receiving anything from them, that we have to pay. But this is free money for education. And of course, it's only free money when you're doing some of the work. So if you're putting in $25 a month, and a grandparent can do that for grandchildren, that works out to over the lifetime, 18 years up to when the child goes to post-secondary education. That's $5,400 that you've contributed at only $25 per month. The government's going to kick in 20% or $1,080 toward their education. Now we've assumed a small amount of interest of $2,100 at a 3% rate per year.
Which is fair, taking a look at interest rates right now.
Yeah, you really don't want it in something that's very risky, of course, because this is for a child's education. You don't want to lose the money. And anything that's in an RESP can be invested much like an RRSP as well. So you can go into the market in something a little bit riskier, but not necessarily recommended. Okay.
And of course, the beauty of the education fund is that when the child needs to use it, they're not going to be taxed on it.
Exactly. Well, it is taxed, but it's very, very low tax because it's taxed at the child's rate of taxation. And most 18, 19-year-olds are not making a whole lot of money. So that's the beauty of this. There's no tax savings going in. Well, you're not taxed as the contributor on that income, but the child's going to be taxed on that income when it's withdrawn, which really is nil.
Okay. And the $8,500, that'll go a long way to help with the tuition.
For sure.
The books or the accommodation, whatever they need as they head into their post-secondary.
Well, I mean, my son who's 26 now, when he went to Carleton, I think his books were $3,000 for the year.
Yeah, depending on the program.
Crazy.
Yeah. Now, if you don't start at birth, if this is something you're hearing about this morning, you think it's a good idea, perhaps the child is a little bit older, it's not too late to implement this plan.
Yeah, exactly. So we've given an example of someone that's a child that's 9 years old. So if you turn that $25 now into $50 a month, you're going to have a little bit less, but it's still $5,400 in contributions for the next 9 years. You're still going to get that free money from the government. I mean, how great is that? When do you ever hear that? A little bit less interest, of course, because that's the power of compound interest. You're going to start late, so it's less than $1,000 in interest, but there's still going to be $7,000 there. I mean, a lot of tuition today is in that $7,000 to $8,000 for university programs. And again, we're assuming a 3% return. Now, that money can also be used not necessarily just for university or college, but any trade schools. There's a ton of schools that are accepted, and you can even use it for learning in other countries as well.
Oh, great. So an international study.
Absolutely.
Now, the beauty of this is that it is accessible through pretty much all the financial institutions, right? So depending on where you bank, this is a program that's offered. Yep,
financial advisors, through your bank. Of course, we offer it as well, but it's very easy to set up. You can do lump sums as well. If you've been putting some money aside and have it buried in the backyard maybe until your child goes or your grandchild goes away, then you can also do lump sums.
Is there a maximum amount that you can put in this account?
There is. There's some restrictions. Keeping it simple, it's about $50,000 per child that you can put into an RSP.
Okay.
And the maximum grant that's available is $7,000. Now, if the child doesn't go away to school, your money's not gone. There are options for taking that money out. It can be taken out as income. It can be rolled into your own RESP. But of course, that grant money is gone because the government's giving you that money in the assumption that you're going to use that money in order to pay for a higher education.
Good advice. Thanks so much, Sean.
Thank you.
We'll see you next week.
This Dominion Lending segment has been brought to you by Sean Binkley, broker and wealth and insurance planner.